Welcome, everybody, to our Leaders in Housing Counseling call. We first went in October. Glad to have you. We've got a very full agenda, so we're going to dive right in. I want to do a quick overview of what we plan for the call. So we're going to give you the latest on what's happening in Congress and Melody's work in the legislature. Do a quick plug on our planned disparate impact call on Monday coming. Very important. Hope you are all planning on participating. We'll talk about it for just a moment. And then we're going to have a very interesting talk with Kim Johnson from Housing Coalition. And we're getting somebody's background noise here. It'd be good if somebody would mute. And so the talk will be about homelessness and the Trump administration's most recent effort now on homelessness. It's kind of an eye-opening talk. I think you'll find it very engaging and a little bit troubling, but really worth it. And then most of the call will be on this community lending initiatives in mortgage banking. The acronym is CLIMB. And I think Lupe is actually only going to be listening, and it'll be Gabe Del Rio from the Homeownership Council of America to give us some deeper background on different models for how to participate in the mortgage banking process. So that these are much more ambitious, I think, than we've talked about on previous calls, and it's pretty interesting, and whether these are opportunities that groups might want to consider and the work that they're doing. We'll do a quick plug on the NHRC membership, and yes, you can still get the credit report discount through our program. I got 2 calls last week about whether that was still available or not, and yes, it absolutely is. I'll give a very short thing on that at the end, and then our next call will be in 2 weeks. So with that, quickly, let's pivot to what's happening in Congress. So Melody.
Hey, Bruce. Thank you, everyone. I'll just jump right in. Mute your line. Not much has changed since our call last week. As I said last week, the Senate Appropriations voted to fund housing counseling assistance at $45 million for fiscal year 2020. This is a $15 million difference from the House number of $60 million for the fiscal year coming up. We were all pretty disappointed, but we're still working just as hard to try to close the gap between the 2 numbers and hopefully convince the Senate of the importance of increasing funding for the program. Right now, the Senate is in recess until October 14th. We're planning to use the interim time to make the case for conference leadership. Again, those who will be in conference will be the chairman and ranking members of both the full committees in both chambers, as well as the subcommittees for Transportation HUD, which has jurisdiction over the housing counseling program. If you see your senator on the screen, please reach out. We're hoping that we can try and coordinate advocacy calls between their offices and the housing counseling agencies to really make the case on why funding is so critical. Just to let everyone know some updates, we have had calls with House leadership and Appropriations PHUD, in particular Chairman Price, and Ranking Member Diaz-Balart. So we spoke to Price's Legislative Director, Sean Maxwell, as well as his committee staff, Rebecca Soleil, and they're very supportive, as well as Ranking Member Diaz-Balart's office, Chris Sweet, I should say, his legislative director. They're all on the same page, and they're very supportive of the $60 million. So we're confident they're going to hold the line when they go into conference. But unfortunately, as they explained to us, and we can understand their point, when the Senate works from such a small number, it kind of changes the conversation. They were all anticipating, as were we, a $50 million figure. And so just having the conversation begin at 45 on the Senate side it's just a harder hill to climb. But we're hoping that we can be able to reach out to Chairman Shelby and Ranking Member Leahy, as well as other members of the Senate Appropriations Committee, and try to make the case on how important it is for funding to be increased. We had really good conversations, for instance, with Senator Blunt's office from Missouri. Thank you, everyone on the line from Missouri who's really made the case to his office. They're very supportive from what they tell us of housing counseling program. They recognize its benefit in their state. And that's just a great example of how, advocates in the state have really worked hard on showing their value to the community constituents that senators represent, and we're hoping we can try to duplicate that across members of the Senate Appropriations Committee. So again, just keep an eye out from me on emails. I'm hoping to reach out sometime Monday morning.
And I just underscore this, if you don't happen to be living in the states that are listed here, not a problem. Have your, especially in the Senate, have your people talk to leadership in appropriations about that in conference that we really need them to get closer to the House number, 60 million, rather than the $45 million. And I think as we walked through last week, what we have learned is that the reason that they came in such a low number is they thought that there was money in the HUD housing counseling line item that had been unspent from previous years. And in fact, all that is the fact that the congressional budget process had been so badly delayed that it took longer for the NOFA to get issued, and they just announced the awards, as you probably all know, yesterday evening. So that explains why there was money that had not been used in the budget line item. And they did say, so the Democratic person in the Senate said that they would reevaluate if there's new information, and we hope that they understand that as new information. But again, it's all about people saying this is important to me, and we'd like the Appropriations Committee to be moving on it. So everybody can contribute to this, and really they're making these decisions right now. We don't know when they will actually do it, but it's really helpful to have the conversations now, and especially if people are in recess, there might be community meetings that you can attend, or certainly you can call into their offices. We also Melody's been doing a fair amount of work on disaster recovery, on the Community Development Block Grant disaster recovery legislation, and we're hopeful that we're able to encourage some Republican senators to co-sponsor. We'll know more about that soon. And then we continue to work on the Financial Literacy Act of 2019, which provides a discount on FHA loans and for people to go through counseling. And we've been getting some good support in the Senate there, and we're hopeful that we'll be able to have some good news in the next month or two. Cool. With that note, let's move on quickly to the disparate impact conversation. So as I think people know who've been familiar with these calls, disparate impact is the critical issue that in the courts, while I think the world no longer has provisions that say that a house cannot be sold to anybody of color, or very blatant discriminatory elements, rules that may look neutral on paper, but in fact have a disparate impact on protected classes, on people of color, of people with family status, for all the variety of things that are covered, for example, in fair housing, that this way of looking at it has been upheld by the courts and has been the primary mover for our ability to have good enforcement around discrimination issues, and not just in housing, but in a whole range of things. So we're going to do a deep dive. It's going to be a large cooperative call with the National Urban League, with Unidos US, with National Capacity, with the National Fair Housing Alliance, and now the Americans for Financial Reform will join us for the call as well. And it's really aimed at housing activists and housing counselors. So this is going to be our kind of call on this as well. So we hope you join us. It's on Monday at 1 o'clock Eastern, 10 a.m. Pacific Coast time. We think it'll be a useful and an important call, and I will post something about the call after we're done with our call, so that people have another chance to sign up for it. With that quick note, let's move on to our guest, Kim Johnson from the National Low Income Housing Coalition. And Kim, thanks for joining us. We want to hear from you about the Trump administration's activities on our approach to homelessness.
Sure thing. Thank you all so much for inviting me to speak, and of course for the important work that you all are doing. So my name is Kim Johnson. I'm a policy analyst with the National Low Income Housing Coalition. In case you're not familiar with the work that we do, we are a DC-based nonprofit that is dedicated solely to achieving public policy that ensures people with the lowest incomes and people experiencing homelessness have affordable, accessible, decent homes. So with that, we can jump right in. Next slide, thank you. So as I'm sure that you all have heard, over the last few weeks, the Trump administration has announced that it's planning an executive action on homelessness. We are not, as of now, 100% sure what the specific details of the administration's plan might be, but based on information that's been released, it sounds like they'll be calling for increased criminalization of people experiencing homelessness, and they may also propose sweeping people experiencing homelessness into federalized homeless camps. So if you can advance the next slide. So the criminalization of homeless people is obviously not a solution to homelessness. The solution to homelessness is affordable homes. So we have obviously a lot of problems with what might happen under this executive order. A ruling from the Ninth Circuit Court of Appeals in Martin versus Boise established that homeless people can't be punished for sleeping outside on public property in the absence of adequate alternatives. Criminalizing people for engaging in life-sustaining activities may be considered cruel and unusual punishment since the need for sleep is unavoidable. And criminalizing homeless communities only furthers the link between homelessness and imprisonment. So involving somebody experiencing homelessness in the criminal justice system increases barriers to escaping poverty that they're already facing, and it just ensures that the escape from homelessness is all the more arduous for somebody. It's also worth noting that incarceration is not a cost-effective solution to homelessness. A study from Yale University found that cities spend an average of $87 per day to jail someone versus $28 to provide them an affordable home. Next slide, please. Thank you. So we agree with the idea that federal intervention is necessary to match the scale of the homelessness crisis, but given the Trump administration's record of proposing cuts to or the elimination of programs that would actually help decrease homelessness, we can't believe that this effort is being made in good faith. So a few examples include the President and HUD Secretary Carson proposing drastically shrinking or eliminating programs that keep low-income people affordably housed. So in the President's fiscal year 18-19 and 2020 budgets, he proposed slashing funding for HUD programs by 18% and eliminating the United States Interagency Council on Homelessness. They've also proposed tripling rents for the lowest income residents of federally subsidized housing. They've proposed evicting 100,000 people, including 55,000 American children, from subsidized housing by changing HUD's mixed status rule. And they've proposed allowing homeless shelters to discriminate against and refuse shelter to trans people and other members of the LGBTQ community by weakening enforcement of HUD's equal access rule. So given this history of policies that would harm people experiencing homelessness, it's difficult for us to believe that the administration's actions are being made in good faith. And if you could advance the next slide, please. Thank you. So the administration also released a report from the White House Council on Economic Advisors that was full of misinformation and cherry-picked data points that were used to validate gross assumptions about the causes of and solutions to homelessness. So some of the causes that this report claims, some of the things that this report claims cause homelessness include overregulation of housing markets, underpolicing of homeless communities, and a quote-unquote higher tolerability of sleeping in the streets. So it's just too easy to be homeless, and that's why people are choosing it. The prevalence of homeless shelters, they also say is a cause of homelessness. So, you know, if there's homeless shelters to go to, why try to find stable housing, I guess. And they also blame they blame homelessness on higher rates of mental illness and substance abuse. So we have obviously a lot of problems with this report, and to me, it reads as though the writers essentially came to the conclusions before actually doing the research, where they decided these were the findings that we wanted. Now let's go find research that can match what we want, what we ultimately want this report to say. Next slide, please. So in response to some of these actions, to this proposal, we've been working with Representative Katie Hill in California to write a California delegation letter, which was signed by every California representative except for Representative Waters, who will be doing her own action, and Speaker Pelosi, who couldn't sign on because she's the speaker. We are also working with Senate Democrats to introduce a messaging bill aimed at addressing the true cause of homelessness, which, among other things, would fund the Housing Trust Fund at $40 billion and fully fund housing voucher programs. And we are in the process of drafting talking points and are monitoring the situation closely. So as soon as those talking points are finalized, we'll be releasing them. So that's my little spiel on what's going on with the executive action on homelessness coming out of the Trump administration. I unfortunately have to run to a Hill meeting after this, so I won't be around for the Q&A, but if anybody has any questions, you're welcome to email me at kjohnson, that's KJOHNSON, at nlihc.org. And that's it for me.
Well, thank you, Kim. So just in terms of what kind of action steps there might be, or what do you think needs to be done at this point, or are we still waiting?
At this point, we're kind of still waiting, and it feels a little bit frustrating to be waiting, knowing that like something terrible is likely on its way, but it's a little bit difficult to plan direct action when we don't have the specifics of what might be happening. We have been talking to some members of Congress about just kind of like putting it on their radar as something that might be coming down the line that we should start preparing for now, and that might look like, you know, having a committee here, like a hearing in the House or the Senate on the state of homelessness, just to try to counter some of the points that this White House Council of Economic Advisors report is putting out. So it's a little bit difficult to plan direct action, but we will certainly be doing our best to be at the forefront of any action that comes out.
Well, totally appreciate your leadership role on this and other issues. It's excellent and very helpful work. Also been very interesting to see the mayors in California have been responding in very strong ways and help change the narrative on this.
Yeah, definitely. Very interesting and very just, you know, heartbreaking in certain ways. I don't need to tell you all that, you know, homelessness isn't easy, and, you know, targeting people who are already very vulnerable is not a good way to create a better future or create an answer to this like overwhelming problem.
Absolutely. Well, thank you very much, and keep us in touch and keep us informed.
Thank you so much.
Good. Let's move on to our next topic, which is this idea of can housing counseling programs think more broadly about their work in the mortgage process. And Gabe Del Rio has been on our calls in the past, has brought in, I think, sort of big ideas, sometimes visionary ideas about how we might think about our work in ways that are broader and do generate new income. And I think he's working a lot in the field of mortgage banking, and this creates opportunities that are worth thinking about. So this is part of our Innovations in Housing Counseling series, and we're glad to have Gabe back. Gabe, are you with us?
I'm on. Thank you, Bruce. Thanks
Great.
for having me. So hi, folks. Gabe Del Rio. I am the president and CEO of Homelessness Council of America. And, you know, we're a nonprofit in this world, and we really serve the industry. And so we are not a consumer-serving organization, but we're an industry-serving organization. Our mission is really about and economic opportunity for underserved communities, and doing so with home ownership. And the way we accomplish that is working with CDFIs, these organizations. So our main program, our CLIMB program that you're going to hear about today. And then we also partner with industry leaders around innovation, capital access. We've brought some down payment assistance products to market. We're helping build delivery systems that connect the capital markets with direct access points in nonprofits. And all of this is the effort of essentially building sustainable delivery systems, sustainable in that you can keep these up and running because they have revenue and they generate revenue, so they pay for operations, and they're organizations that already have a mission, purpose, and a desire to work with underserved communities, which in this country are really people of color, folks of limited English proficiency, low and moderate income folks achieving home ownership, and many rural communities that are shut out of a lot of options that urban areas receive.
Gabe, you're not coming through as crisply and clearly as we would like. There's sort of a you're kind of going in and out a little bit. Is it possible to call in on a handset?
I can try and do it direct on my phone there instead of the headset. Is that a bit better?
I bet it is.
Okay, let's give that a shot. I'm having a hard time advancing the slide. For some reason, my controls are not working on the slide. Could you advance that, please?
Melody's on it.
You can move past. If you'd like more information on our organization, really just go to homeownershipcouncil.org and you can find more about us. We're going to go through that. We were founded in 2005. We're another nonprofit in this space, and we really just serve the industry directly. We're primarily focused on our capacity building program, but we do all kinds of things with capital partnerships and down payment assistance and loan product partnerships. And I work with a variety of policy leaders, and I would say that I bring a very practical approach to those things. I often the only person in those groups that have actually executed on lending or down payment assistance or been the actual provider for the consumer. And so we try and bring that practical approach to the policy world. And then we do some interesting things with events and promotions, not as much there. We did publish a white paper this year. If you're interested in more information on that, please, you can go to our website and download it. You can read it there. But it really focuses on the underserved communities. And we take an angle of talking to the lending industry and to the capital markets and saying, you know, this is really an opportunity. And so instead of the approach of sort of beating them up about what they don't do, we instead are taking the approach of more selling the investment opportunity and the wise investment that lending to and providing capital access to underserved communities represents. So that's our approach there. So here's what we're going to focus on today is really our CLIMB program, our community lending initiatives in mortgage banking. And this is where we help organizations to move up what we call the lending ladder. And we've created this graphic here, the HCA lending ladder, to help depict for the nonprofit industry what engaging in the lending industry looks like and what the differences are among these different engagement types. So I'm going to spend a good amount of time on this slide here and just sort of do an overview of the range here of how folks around the country, hundreds of nonprofit organizations are engaging in this work. So I start all the way to the left, and you see dollar figures there. The dollar figures that go across the bottom, those are all based on a $150,000 first mortgage loan amount, or you could also say $150,000 purchase transaction. We did that to have a national number that would be applicable in many markets. So you can make an adjustment based on your market or what you think your first mortgage loan amount on average is for the consumers you serve. So the first rung on the ladder there is really what we call packaging work. And that's where organizations are not required to be licensed. They can earn fees. There are a variety of models here, from Bank of America's Connect to Own, to the Springboard Mortgage Collaborative, the New York Mortgage Coalition. There are groups that work with 502 packaging around the country in rural markets. There are DPA packaging programs or down payment assistance packaging for cities, counties, CDFIs all over the country. But basically, this is the work of helping a consumer gather up all the required documents for an application, get them organized. In general, I think it's also important to be able to help them run their own debt ratios and make sure that they're also complete and accurate with all of their documents. And so that's the packaging work. And those earn fees of $250 to actually above $800 per package, if you can get yourself with a packaging partner. The next rung on the ladder is really down payment assistance lending, which could include either administering a program which is someone else's capital, or it can be your own program, or both, administering someone else's funds that you actually control. So there's a variety of different models here to administer down payment assistance programs. These can be local CDBG and home funded programs, or housing trust fund programs in your local area. These also could be some of the many programs funded by NeighborWorks America, who've provided a great deal of capital to the industry over many years that have created revolving loan funds. Additionally, that is true for the CDFI fund, who have put out a lot of capital for loan funds, though it is a minority of where their funds go. And there are other state and federal home loan bank programs, et cetera, that provide down payment assistance that nonprofits take part in or administer. And so that's another piece. Now, down payment assistance lending or administration in and of itself actually doesn't require licensing. There are law-exempt areas for this work, and in general, one must be a non-profit organization, and that's the main way that down payment assistance and the interest of it, or the benefits to the administrator, are generally regulated through that process. Moving into the green area, we begin to get into the license roles of your standard mortgage banking. The first rung on that ladder is becoming a mortgage broker.
So sorry to jump in, this is Melody. You're breaking up again.
I'm not sure what I should have shared that I am going through the humbling experience myself of selling my house and moving. So I'm calling from my home office, and I don't think there's anything I can do about my reception.
If you can just try to speak closer to the phone, maybe perhaps that will help.
Sure.
Thank you.
Okay. So this next area here, the green areas, are really the licensed lending activities. That's where it begins. The first rung is mortgage broker. In many states, there is a real estate license or a mortgage broker license that would cover this. It's one of the two, and in some states it does both. But in any event, this is where an organization gets licensed as an entity and also has licensed staff. So you must be NMLS approved as an originator, and your entity must be NMLS licensed, as well as the broker themselves. This does not require an underwriting decision on staff for the first mortgage. And in general, mortgage brokers are compensated approximately 2% of the origination amount, or the loan amount. That's what they earn. So you see $3,000 is listed. As an example, that is 2% of a $150,000 first mortgage. The next rung on this ladder is where people begin looking like a lender of first mortgages. We call mini correspondent lending, or non-delegated correspondent lending. And the difference here is that an organization can have a warehouse line of credit in order to fund mortgages on, but they are not performing the underwriting decision themselves. That's the delegated aspect. So they're not delegating underwriting by the investor, and that's why it's called non-delegated. So if you would provide the loan file to the investor for underwriting, they would make the decision on the file prior to you funding it, and you would fund it on your house line. That allows you to earn a 2% origination fee plus their fees because you're a funder and closer of the loan. This, again, is in fully licensed area here, earn those fees. I'm going to move into the blue section here. This is a rare set of organizations, frankly, that are active in this space. There aren't too many. I'd say there's probably under 100 nonprofit lenders who could qualify as a correspondent lender. And that's where the underwriting decision is fully delegated to the lender or the nonprofit in this case. These organizations almost always are CDFIs already or become a CDFI, Community Development Lending Institution, or financial institution, sorry. And in this case, you do end up earning more revenue because you're also taking on that underwriting and you're a part of the risk decision. And so you can see in this case that we've put a 3% margin on there plus fees. So that's 3% of the loan amount. Not only would you need to be a licensed lender, not just a broker, you also have licensed origination staff, and you would need to have an experienced underwriter to make the underwriting decision in order to be active in this particular column. And that's what we call correspondent lending. It's when you lend on behalf of investors' programs. So you might have, in this case, Quicken and Chase and Wells and a variety of other large correspondent investors who are purchasing the loan from the correspondent lender after the loan has been closed. So it's a whole loan sale execution. And that's when you fully earn your 3% when you sold the loan on the back end. The final category is even more rare air. There are about 15 nonprofits in the country that are approved as a direct seller or servicer for the GSEs, another for Fannie Mae or Freddie Mac. And either of those sales outlets or GSEs are where those approved seller servicers are selling the loan to. Importantly, they are responsible and are keeping the servicing of that loan, either approved as a servicer for Fannie Mae, who do not directly service their own loans. They only buy loans, investor in that. When you're a direct seller servicer, there is up to and sometimes exceeding 4% margin to be earned on the activity. There's quite a bit more risk involved. You need quite a bit more staffing capacity in order to perform these high-level functions. This is the highest level of interaction in mortgage banking, and folks like Quicken are themselves a direct seller servicer to the GSEs, to give you an example. There are about 500 of these organizations that are for-profit nationally. There's over 500 direct lenders to the GSEs, and those are many of the mortgage bank brand names that you would all know. We can move to the next slide here that fully describes the ladder. This is a quick overview of our process. When we're working with an organization, we're generally helping them to become a broker, issue a new down payment assistance program, or become a DPA lender, or move from brokering into mini-core or correspondent lending. In one case, we're working with a really fantastic organization named Fahi that recently achieved the seller servicer status with both Fannie Mae and Freddie and we're working with them to establish and build out their correspondent lending channels, enhance their broker channels, which they've already had a strong network of, and continue to build their direct retail lending as well. So when we're in this process of climb, we do a lot of upfront research with organizations. We want to know that you're strategically headed in this direction. We would like to understand every moving part of your home ownership engine. And we do all of the upfront reading on that we possibly can, from production reports to org charts, staffing plans, balance sheets, loan products, down payment assistance, systems used, production history, goals, and strategy. We then have an on-site session when we're working with organizations. So we go and work with the leadership team directly on site for at least an entire day. It's usually a day and a half. And we do a discovery and planning session. And this is where I like to say we go through every moving part of the homeownership engine from start to finish, systems, compliance, staffing, production, handoffs, compliance, you name it. And we go through it together as a team. We inspect the part, we make sure everyone understands it the same, we see where you are today, where you want to be, we fully define that gap, and then we get to work creating an action plan that will meet that gap and close it for you. And that's what gets written up into our tactical action plan. We call it a tactical action plan because it is tactical. We're not talking about strategic direction. We are talking about how you are going to get there, a step-by-step process, step-by-step directions, or milestones that you will have chosen as we go through the on-site planning session. And we write that up into a really implementable plan that is a working document that you can utilize daily. We do not want to make a plan that sits on the shelf. This is really a work plan, work products that we provide our organizations. And we get into a project management tracker, and that's really where our work finishes. Because we have a 1C3 with a mission, we with you, and we've got organizations that after this we work with for 6+ months on regular calls to check and see how you're doing on your milestones. It's just sort of block and tackle any obstacles, challenges along your way. Folks, is the overview of crime, how organizations engage in this space. One thing I would like to remind you, we like to say, there's a great saying from Lupe, this slide talks about the details I just shared with you. Lupe likes to say this, and I love it. The firewall that you all have to work with for housing counseling and lending is more of a fire brick than a firewall. You need to know how to work with it, what you've got to do, but it's less of an impediment than you think. We often hear from nonprofits that they don't think they can charge fees or earn money. And that is a big misconception. That same misconception is getting in the way of this industry, and it's why many organizations are closing their doors. So it's important to think about what you can earn for the value that you make, and it's important to understand the value that you are in fact generating for the community. And it's my mission to make sure we're getting paid for that work and that value, and that we engage organizations in revenue generating opportunities that will keep your doors open, and not only that, but allow you to help more people than you help today, which is what we all really need to be doing to meet this need. If you'd like more information, or you can always go to our website at homeownershipcouncil.org. You can also email Lupe, Lupe at homeownershipcouncil.org. We do this, Fannie Mae sponsors us to do this work, for instance. We're working on NeighborWorks projects. Organizations have their own resources and have paid us to do this work. And then because we're a 501c3, we've also raised money and continue to raise money to pay for this work for organizations that have identified themselves as needing it or wanting it. So it's important for us to know where and when that's appropriate for you to be on our list if you don't have the resources yourselves. And we do our best to resource it for you and get you on the schedule. I think that's it for us, and I'll take any questions for instance.
Thanks so much. And we do have some questions, and you are continuing to fade in and out some, and we should just do the best we can. Sometimes you come in quite clearly.
Sorry about that.
Yeah. So Melody, what have we got?
Sure. So I'll start from the beginning. We're getting a flood of questions. Can you detail the rationale behind the different fee ranges referenced in the lending ladder?
Sure. If we go back to the slide, you can actually see it. So the only thing you don't see the calculation for is the packaging. So you've got packaging fees. $250 is a connect to own example. $800 is a wide example for a variety of packages. And there are mortgage coalitions and collaboratives that actually pay more than that $800 per package. The DPA program lending fees, those again are live examples from the field of charges or fees that nonprofits have for down payment assistance program admin. Again, I think they're conservative on the high end. You know, when I've been a direct service provider in this space for a couple of decades, and we charge $2,150. So, you know, we had $2,150 as a standard fee to the fund, not to the client, for our administration of that down payment assistance program, because we had to underwrite it and process it and close it and fund it and ship it. And so when you do all those activities, they add up fees, and you know, that's an example there. Everything else on the chart, you can actually see from the 2% origination, it's 2% times 150,000, it's 3,000. 2% plus fees, it gives you an idea of the difference there. The delta is 1150, so you've got 1150 in fees. That would be something like processing, underwriting, loan tie-in. We also call these fees junk fees in the industry, but they're just essentially meant to capture or to pay for your operations costs to process, underwrite, close, and fund the loan. Again, very similar to the down payment assistance. In the correspondent lending, you're actually allowed to set your own margin on each of the loan products or channels within your sphere. So that 3% is actually just a low average of what a mortgage bank generally adds on as margin, which does not get passed on to the client in a direct fee. It's paid from the investor to the lender as the loan is sold. So when the loan gets closed with the borrower at rate X, that loan is shipped to investor, and the investor pays that 3% margin to the lender once they purchase the loan. That's how that works in correspondent lending. The same is very true for the direct lending to GSEs. The margin is the same. You earn it at the same time. There's an additional revenue stream as our servicer, which is premium. Either that's earned as a service release premium, or it's going to be standard earnings on the actual service activity.
Thank you. The next question: Can an organization be a HUD-approved housing counseling agency and perform mortgage broker or mortgage correspondent service?
So many HUD-approved organizations also have related entities or a subsidiary, or are themselves a subsidiary of another entity that is a licensed lender. In the Neighborhood America network, of the 100 plus homeownership centers that are out there, a large preponderance of those organizations are active lenders in the down payment assistance space, mortgage brokering space, real estate services space, and as you know, of course, are also HUD-approved homebuyer education and counseling providers. There are also cases where groups like NID, who were started by realtors and came from the real estate space, have gained their HUD approval in order to provide HUD-approved buyer education. So it is an active management of compliance. However, it's more than I think anyone is generally used to. And you have to provide choices to clients. You cannot require them to use your services, and you must disclose such in writing. It is that simple.
And does it need to be a separate entity that's doing at least the stuff that's in the green or blue, a separate corporate entity from the one that provides the HUD-approved housing counseling agency, or just different staff?
That is, I mean, that's really a legal question, and I'm not a lawyer. However, I would say it's best practice. I have had many attorneys agree back in the 501Q days first came out, and I've had a lot of national conversations around compliance. We all agree it's a practice to have a separate entity. It is not difficult to create a corporation. Not difficult to get those formed and licensed. However, there are lots of examples where the HUD organization themselves are also the licensed entity and are active. And as you said, Bruce, they do them in that case with different staff. So if you don't have corporate firewalls, you do have different staff firewalls. And that, and bottom line, if you're disclosing, you're making it really clear to the consumer, you're providing options, and you are not requiring them to use your services or products, then you're going to be compliant.
Thank you. Is there a cost to participate in the program to a housing counseling agency?
Yes. So this effort is an effort per organization. And so, we do have a fee for our service. I would say we've been giving more certainly this year. If you're interested in that, let us know. Like I said, there are ways organizations have the resources themselves to pay for the services. And we go ahead and engage on that. And if not really appropriate for you, to be a good thing that you don't have the resources, then we put you on our list and we do our best to fundraise you. And we can also jointly fundraise to provide those. Many times too, what we're providing you is something that you fundraise for. I can use an example that's just from the last 90 days. An organization they're working with, they happen to be a NeighborWorks organization. They're a HUD-approved counseling agency. They're getting more and more active in the first mortgage space, and they utilized our write-up to raise $100,000 in support. And it's because they had a really clear action plan. They knew exactly what their gaps were, and they were working actively on it. And they took that plan to a funder, and the funder said, hey, with that well put together approach, we're going to fund you. So I think we end up paying for ourselves many, many folds over. And that's not even mentioning the business earnings that you normally get, ongoing once you've installed the business line, which is our goal with you.
Thank you. And as an amendment to that, what's the average cost?
Per organization, $15,000.
Okay. Many loans are portfolio products to our clients. So is this a system that can work?
Say that one more time.
I guess the question is that they want to know the sustainability or feasibility of the system, given that loans are portfolio products to clients.
So it's a little apples and oranges. So if the fact that you portfolio loans is merely that you're your own investor, so in that case, I think you would be probably in the DPA category, unless you're portfolioing first, in which case I'm guessing that's also not at a very high volume because it takes a lot of money to sit in portfolio first mortgages. So, nothing is preclusive about that. In other words, that is simply a capital management issue, and it's one of the many things we talk about in our process, and it's one of the many options and choices you have in the lending sphere.
Thank you. Will this type of lending be in direct competition with lending partners in their area?
Well, I think where you have the best product, yes. And that's yes. Should you be at some point? Yes. Should you be worried about how you're going to pay your bills? Yes. Are they probably paying for all of your operation? No. So I'm unapologetic that you have, this industry has a need to earn revenue for the value it creates. And at some point, a loan officer might make a less commission. And I am not worried about that. What I am worried about are the investors who buy these loans and the people who get to purchase homes as a result, right? So generally, you're not disruptive of anything to an investor level. Where you are disruptive when you open an origination business is to originators, loan officers. Now, what I tell you is that loan officers are not on measure as a country. We are not serving these categories of borrowers. And they're not very interested in solving for these clients. Let alone for someone who's ready for a loan right this minute, if it's a size loan. Outside of that, I would say statistically and by the numbers, they're doing the work. So you tell me if it is competitive with them or not. I think there's a lot of space to be serving underserved communities who aren't accessing credit today, who those officers are not serving right now. And it's not my problem to feed them. It is my problem to get those communities into home ownership and to make sure that organizations like yours are sustainable so they can continue to serve that population. Because the need is far, far greater than the total number that this industry produces on an annual basis. So we've got a long way to go.
Great. The last question that came in was, and I guess it's because you were a bit muffled earlier, could you provide the audience your contact information, email, telephone number, in case they have additional questions and want to contact you?
Absolutely. So our website is homeownershipcouncil.org, COUNCIL. And on there, actually, you'll find our phone numbers. You can click through, fill out a form. You can email us. My email is gdr at Gabe Del Rio, gdr at homeownershipcouncil.org. Lupe Hernandez, our COO, who also works for our incoming client organization, her email is Lupe, Lupe, at homeownershipcouncil.org. And both of our direct phone numbers and the office links are all on the website, the Contact Us page.
Great, thank you.
Okay, great. Thanks so much, Gabe. Very, very interesting. Love to see how this all progresses. So
thanks, Bruce.
I'm going to move quickly on to just a quick reminder that please, if you haven't already, please join NHRC. Many of you are already members, and thank you. We've had a very good year in terms of renewals, especially, so it's been great, but we've been getting in new members as well. We still have the discount on the credit reports. Happy to send you information about it if you want more about it. But the real reason for joining is really to support the advocacy work that we do, and this gives us the kind of flexibility that we can move on issues that all of us care the most about. With that quick note, we'll be back again in 2 weeks with an agenda to be determined. So if you've got a boiling issue you think we should highlight, please let me know, or let Melody and Ellie know so that we can put it on our screens. Please plan on joining us for the Disparate Impact call on Monday. It should be a very good team of people on it, and I will post a note about it soon so that you have another chance to click in and join us. Good. Thanks for all the good work you're doing out there. We'll stay in touch. Bye.